Welcome to Unfiltered Finance. I'm your host, Emily Turner. We're joined today by Nate Tucci, our options expert. And we have a new headline we're going to talk about today, which is that options are now opening earlier than before with a handful of stocks, and how this can maybe dramatically change the landscape. Nate, do you feel like that's an accurate statement, an accurate?
Yeah, I mean, I absolutely think it's dramatic. I think in general, people have undervalued this expansion of time and windows, maybe not realizing how much time horizon in general impacts, especially the options market. Just to give you one basic example, a zero DT option, which now make up over 50% of the overall market, so hundreds of billions of dollars a day, are all based on 6.5 hours of time. So you now increase that by 25% essentially when you open the market earlier. And so all of the Greeks and the ROIs and everything that goes around zero DT options are going to change because hours are a huge part of how those valuations work.
What do you think is going to be the biggest change here, other than, yeah, there'll be extended hours, so there will be more trades, potentially more traders too, theoretically. But like, what is the biggest change?
To me, the one that stands out is that for decades, trading the pre-market news has been locked out for options traders. So people will trade it on the underlying stocks, but especially they'll trade it in Forex or futures, the non-farmed, the CPI, the PPI, all these big data points, because they're essentially moments on a calendar that are coming. They're going to create big moves in the market. And options traders have always seen those events take place, hoped or crossed their fingers or waited, to see how they would settle. And then an hour later, once the settle has already occurred, maybe they make a trade or an adjustment, but they haven't been able to trade the news directly. Now, putting aside whether that's a good idea, I do think that is going to be one of the big changes that stands out, because as traders, you always want to trade the big moves. For options, a lot of those big moves happen on predefined 8:30 a.m. style announcements that now you could theoretically trade with a zero DT option that can move 100% or 200% within 5 minutes.
So as someone whose, approach has really been specifically targeted around the opening bell, how have you changed that with what you do?
Well, I think for right now, it's very limited changing because it is just a handful of individual stocks. To me, the next wave, and where I think things will actually change fundamentally for me, is when the indexes are trading from that same 7:30 to 9:30, because once the SPY, SPX, QQQ are trading in that same window, now you get a much bigger chunk of that 50% volume for zero DTE that's also moving earlier and active earlier. Like I said, the time value curves and things are shifting. But for me, one of the most important ones is being able to hit a target earlier in the day. So for example, one of the strategies that I have is based on overnight trading. We set a target for it, and a lot of times the market is up nicely at 8:05 a.m. And we think, oh, please don't just rip down on this news and blow it for us, because we want to be able to hit that target when the opening bell rings at 9:30. Well, now we will have the chance to hit those targets at 7:35 or 7:55 or 8:25 before the news comes out. So I'm excited about that, but I'm also very interested to see how much they adjust the pricing for that volatility, knowing it, because they're not going to make it way easier to win lots of trades. Like, the CBOE is not in the habit of making it way easier to win trades. But at the same time, those valuations are real. They do have to account for market internals and dynamics at 7:45 a.m. if the market's open. So I think that's going to be really fascinating.
Well, it's interesting between this and then the upcoming 23/5 trading day. How does this completely eliminate the overnight strategy, that opening bell strategy? Because it's not like, oh, the numbers will remain the same and trends aren't going to change just when everything else in the timing has changed.
Yeah, I think that for now, it's a slow transition into blowing up our time horizons. Because again, from 7:30 to 9:30, number one, you've already had underlying stocks being traded, so that's old news. Now you're having a handful of options being opened up, so that's going to be part of the transition. When indexes get listed, that's going to be a bigger part of the transition. When the full 23-hour day opens up, I think that's going to kind of cement that transition. And I think parts of the framework for how the market works will remain, just literally based on Wall Street schedule, overseas schedules on trading desks. So I think there will still be chunks of time that we know will be higher volume, lower volume, and that sort of thing. But I think that transition is happening one step at a time to completely flatten out our baselines for time horizons within the market. And so I would expect that, yeah, 2 years from now, a lot of that legacy foundation will still be there, just, kind of typicality and schedule based. But maybe 5 years from now, no one will really be talking about the 9:30 a.m., opening bell as a strategy.
It'll just be yet another way for us to feel like we're old.
Yeah. I already feel that way, but yeah, it's getting faster and faster, I think.
Yeah. Well, so for people who might be like, "Oh, I'm so excited. This is, more time, more opportunity." Is there a pitfall for this?
Well, I think number one, we don't know how they're going to price these things. So again, it might sound like not that important of a deal, but you have billions and really trillions of dollars in underlying value that are priced based on a certain time horizon. Options have time value. It's a very important part of their value. And that's going to change fundamentally when this opens up. So if you jump in not realizing, let me give you an example because right now I'm talking very theoretical. So right now, the options curve, most people know it's kind of an exponential curve that goes down as time runs out on an option. That works whether it's 365 days and you think about the exponential curve that happens very flat over the first 200, then steepens, then the last 5 days is really steep. But it also happens in a 6.5 hour day when you zoom it in. Same thing. First couple hours are more flat, then it zooms down. Well, this 2 hours is different because it's very news heavy. They're expecting lighter volume at the beginning, certainly. It's individual stocks, mostly that are very high volatility. And so that time kind of curve that we're used to, they're going to mess around with. They're going to adjust and see how much defense they need to play within those first 2 hours. And so you might have, and I would guess that you will have, a foundationally overpriced option period for that first 2 hours before an even normal curve kicks in. So for the people who want to play that fast, fun moving environment and all they're doing is buying overpriced options as a starting point, it's going to be really hard to come out on the winning side. So I think waiting for that pricing to really get figured out, because it will normalize over time, especially as institutions get involved, waiting for that pricing to normalize is going to be, a big part of the equation. There is the chance, on the other hand, that maybe they're underpriced. Maybe you have big 8:30 news announcements that are going to be outsized moves, and because there's low volume, the market hasn't actually accounted for those big moves yet in the options. I kind of doubt that, but something to watch for. And so it could go either way. And I think just jumping in based on, hey, now I want to trade the underlying using options and ignoring how those options are priced is probably going to be the big mistake that retail traders make.
Now, is that something that over time you think that will change? Or is it like maybe the way to approach this is take a step back, let's see how everything changes. Then once the dust settles, it comes to an equilibrium. Also, maybe don't start in the middle of the day and see or start in the beginning of the day and see what happens later in the day.
Yeah, I think it will normalize over time. Again, especially as institutions get involved, which they will probably pretty early on. Again, especially as the indexes start trading earlier. I think institutions will get involved. That will mean that the market makers have to price at scale. Scale always smooths those curves down. And so I would expect that. However, I don't think this idea that, the 8:30 a.m. known announcement needing special pricing is going away. So a good example of this is when the Fed meets at 2 p.m. because then it is during normal market hours when we get to see that happen. The volatility in those options that would normally curve down into 2 p.m. stays very high through 2 p.m. Why? Because there's a known announcement coming. Volatility, is on the calendar for this event. So when that's happening at 8:30, and it's that early in the day, and there's so much time, they're probably gonna have to rip that IV even higher because now you have something that we usually don't ever have, which is a known volatility event with all the time left in the day still ahead. So you're combining volatility event and maximal time in the day. Which we've literally never seen an option price like that before, so we don't know.
Well, and that's the question because you hear so many people warn you, don't trade the headlines, just kind of ignore that. But how do you do that when this happens, this opens so early?
Yeah, well, again, I would recommend not not trading it, especially early on, until we have some idea of the pricing. But hopefully, and kind of my hope is that the volatility for those early days is extremely high because then what we can do is we can take premium based trades. We can take something like Tesla that people expect is going to react to PPI or CPI. It's a discretionary stock. It usually does. And know that normally Tesla is going to, range 2, 3, 4% on the reaction to that news. But there's 5, 6, 7% of cushion or volatility priced into the options. And so instead of trying to be the hero and trade a zero DTE directional play on Tesla, we can trade like a premium based trade. This would be like an iron condor for those of you who are option geeks, or a defensive credit spread or something like that, where we actually say, hey, because the market has a lot of time left in the day and they have to price this event going in, let me just trade the standard that Tesla's going to move it by the end of the day, somewhere throughout the day. It's going to be closer to neutral than the extreme ends that they have to price in. Those, in my mind, are going to be the better trades, and probably the vast minority of people who are actually looking to trade in that way.
Well, we talked a lot about, the first part of the day, but now there is a 15-minute extended window on the back end, 4 to 4:15. Is that just like a throwaway, or do you think that has any value?
Well, it actually has a ton of value for people who are trading zero DTE. So this is a really fascinating thing that I'm not sure people realize. So a lot of times now, people will trade zero DTE or one DTE or five DTE, and so no matter which one you're trading, that settlement date is happening at 4 p.m. on whichever day it is expiring. So again, if it's zero DTE and you're trading it at 9:30 a.m., well then obviously at 4 p.m. that same day, you're looking for a window for price to be on most of these strategies. Okay, so for those of you again who are option nerds, think about like a debit spread or a credit spread or some kind of trade that has to fit in a certain window at 4 p.m. Well, here's the fascinating thing. You could take the identical trade on SPX, which is an actual futures indice, versus SPY, and they're going to have different settlement ranges because SPY is going to settle at 4:15 with an extra 15 minutes where the auction is happening, and actually price can move quite a bit in that last 15 minutes, whereas SPX is going to settle right at that 4 p.m. number. And so people who don't realize it are sometimes, and I've seen this happen, unfortunately, celebrating their win at 4 p.m. on SPY and then realizing it turns into a full loser 15 minutes later because the settlement price has shifted. And again, that's not a quiet period. 4 to 4:15 can move pretty substantially. So one of the things that I would recommend is if you are basing a strategy on, say, like historic back-tested data at a 4 p.m. close, make sure you're trading SPX or XSP and not trading that strategy on SPY, because your numbers aren't going to correlate to the backtest that you think you're trading on that 0 DTE or 1 DTE strategy.
Oh, that's good advice. Yeah, you could end up in a lot of hot water for that one. When it comes to the stocks that are available, right? So it's like Mag 7 and then a few extras. Do you feel like that limit is a good thing, or do you feel like it should be, why not just do everybody?
No, I'm happy they're doing it kind of in that piecemeal kind of, like I said, that slower transition to get used to the market blowing up our time frames that we're used to, kind of one update at a time. I do think that the downside of the stocks that they're picking are, of course, all the ones that retail traders want to chase and trade crazy. Nvidia and Tesla and AMD. I think Broadcom and Palantir are on that list. So like a lot of the retail favorites are on that list. So that part maybe not as good for your average retail trader. But I'm definitely glad they didn't, unleash 1,000 optionable stocks and indexes on one day, because I think that would really break the market in terms of how it operates in normal windows versus how it's probably going to operate here in just a few years once this all gets settled in.
Yeah, you were talking about how these are some of the more popular stocks when it comes to the retail community. Can you talk a little bit more about whether that's about the double-edged sword that might be?
Yeah, I mean, in general, and this didn't always used to be the case, but it's become more true over the last decade, especially, and then even more so as your DT options have been listed. Retail favorites are the most volatile stocks. And that makes sense, right? If you're a retail trader and you want to have fun with options, you're probably not going to be trading Ford. You're probably going to be trading Tesla. And so in general, the stocks that have that really high intraday volume are the ones that are more volatile by nature. So what the CBOE said is they said, hey, there's a standard for a certain amount of volume that these stocks need to have in order for them to make the list for this early window. And so by definition, They got all these ones that have really high volume, which are really high volatility. And so I think the double-edged sword there is that they're good baselines because they do have high volume. So the CBOE is going to be able to price them, accurately. We're going to be able to see this transition happen with, legitimate stocks that are in the Mag 7 that have trillion-dollar market caps. And we're going to be able to make a reasonable transition into more and more volume. And like I said, eventually the indices. But the other side of that is that they are the ones that are going to be most tempting to trade those news events, those big windows. And I think people are probably going to jump in to a new world of zero DTE that they don't realize how much has changed. Again, you're talking about like a 30% change in the value curve of an option that just started happening that most people probably don't even realize.
So what is your warning to someone before they rush in with their Robinhood account?
Oh, I mean, literally just watch the pricing. Like literally just look at the IV changes. I mean, you can do this with, tracking on a pen and paper what that option was priced. If you have data feeds or some cool tools, you can do it a little more effectively. But the idea that we literally don't know is something that you have to take very seriously. Like there are theories and curves for how this stuff will work. But what those theories and curves specifically don't do a good job of is pricing known volatility events in. And that's what we're going to have a ton of in this early window. So we're going into an environment where we don't know. Claude and ChatGPT can't tell you. And we're going to have to see how the CBOE handles some of this pricing, how those curves change. And the skew, in other words, how much people are buying and selling, is going to affect it anyway. So, for example, if the CBOE came out and announced today, hey, folks, this is exactly how we anticipate pricing. This is exactly how we think the time horizon is going to change. This is how we want to price these options. You still wouldn't know because the actual volume that goes back and forth is going to have a huge part of the equation there too. So in my opinion, I think you have to have discipline and say, like, for 60 days, I'm not touching these options. Now, that doesn't mean using like targets and things like that for trades you already have open. I think that's total green light there as far as I'm concerned. But as far as opening new positions and not understanding how the price and the volatility is going to be impacted by this time window, is really a gambling approach. For any options trader, if you don't know how the thing you're trading is being priced, that should be a pretty big red flag that you shouldn't click the button.
Makes sense to me. Well, anything I'm missing?
No, I don't think so. I think the transition will be really interesting. Like I said, if you have trades that you have open and you use targets, that's one thing to pay really close attention to. I think that'll be fun because there is a chance that you're going to steal more wins out of a current strategy than you were before. I don't think they're going to make it too easy on you. I don't think they're just going to price like overwhelmingly to your advantage when PPI is about to come out in 15 minutes and the market makers, as well as us, know that that could change things substantially. But over time, it really can't hurt you on the exit side of things. So that's kind of cool. Like there's really no scenario where it can hurt you on the exit side of the equation. It could only be a net advantage. So there's a win for the retail traders to put in their pocket and then, don't ruin on the other side by opening a whole bunch of new trades.
Yeah, there we go. Just sit and wait and figure it out when you have the lay of the land.
Yeah, exactly.
Well, Nate, thank you so much.
Awesome. Thanks, Emily. And guys, good luck with the new hours. It'll be fun to watch.
That's right.